Hi, welcome to today's video. So today's video is going to be based on how to avoid false entries and false breakouts. Especially as intraday traders, we tend to rely on breakouts and reversals. I rely heavily on breakouts and reversals to trade. In fact, they are a part of my daily arsenal to trade. I don't get into entries where I don't see any breakouts or I don't see any reversals. On such days, I sit out on the sidelines and I just wait for a particular level to be broken. It could be a support, it could be resistance, it could be swing high, it could be swing low, it could be supply demand zones. And the most important part of this is that breakouts most often fail. 90% traders get caught in breakouts. Do you know why? Because traders tend to trade on the wrong kind of breakouts. Now, is there something called a wrong breakout and a right breakout? No, I don't think there is anything right or wrong in the market. If you're wrong, you just take your stop loss and get out of the trade. That's it. But that is not the point of this video. So what we are going to talk about here is how to identify whenever such breakouts happen, that they are legitimate breakouts, authentic breakouts or not. So many times it happens that you see that a particular level has been respected for 2 or 3 times in the past, and then suddenly there is a breakout of that level. What does that mean? Let's say there is a resistance. Price comes and hits the resistance and falls, again comes and hits it and falls. Now the third time when price comes and hits the resistance, there is a candle that goes out of the resistance area. And whenever a candle breaks out of that resistance area, seeing that it is a strong candle, all breakout traders jump on into that candle and take breakout trades, only to see that the trade has reversed and in the very next candle their stop loss has been triggered and you're out of the trade. So why does this happen and how to identify? In fact, is there any way to identify such breakouts, such false breakouts? And are such false breakouts meant to trap traders? So let me answer the last question first. Yes, false breakouts are very much a thing in any type of market that you trade in. And yes, they are meant to trap traders. They are meant to fool traders. The basic concept here is to understand how to identify the correct breakouts. So whenever you see a resistance or a support and you see that the breakout is happening after back-to-back candles, then such breakouts usually don't hold. Such breakouts that happen after immediate back-to-back candles, they usually will not hold. And such breakouts, even if they hold, are low probability. So you should avoid such trades because they are low quality in nature. So just avoid them for the time being, at least as of now, before you master breakouts. Go back to your charts and study where breakouts have been successful. I did the same thing. Initially, I used to think that any and all breakouts are tradable. And then what used to happen was sometimes I used to be successful, most times I used to get caught. So I used to get trapped a lot before I actually went back to the charts and studied it. So when I went back to the charts and studied why these breakouts fail, I realized that such breakouts that happen after continuous candles, may it be bullish candles or may then be bearish candles. So green or red, whatever it is, but continuous candles, a continuous rise from the bottom to the top, and then there is a breakout of a certain level, price breaks out. I never follow such breakouts now. After having backtested many of the charts, after having studied so many charts, I can tell you that such breakouts after back-to-back candles usually fail. So then which kind of breakouts should you trade on? See, I'll tell you one simple concept. Imagine that a lot of people are playing tug of war. The teams are equal in strength, but then slowly one team starts losing people and their hands start slipping. So when hands start slipping, they start aching, so they don't hold on to the rope tightly and the other team pulls them forward. So here the tug of war has to happen between the buyers and the sellers, and one should emerge as a winner. Then take your side accordingly. Don't trade just because one of them has suddenly burst out and become a winner. Have you seen a battle going on ever between buyers and sellers? Do you know the candlesticks that happen at that time? Have you seen dojis? Have you seen sideways markets? Whenever there are sideways markets, what does it indicate? Whenever there are back-to-back sideways doji candles and when you see a consolidation form, what do you think that means? It means that the buyers and the sellers are buying and selling at equal strength. So do you know which one is going to win? Do you know if buyers are going to win or sellers are going to win? You don't know, and you just don't know which side to take. So why do you want to jump in before that result is out? So whenever you see that there is a zone that is forming, a consolidation that is forming, and then a side is winning clearly, then you take the side. So if you see that a level is broken after consolidation, it means that a solid war has happened between the buyers and sellers. And if the consolidation has happened below a resistance, then after the war, the buyers have come out as the winners and they have broken the resistance comfortably and convincingly. So now after the convincing breakout, you can take the trade. I'm not saying that that trade will also be successful. The trades that you take after consolidation, the breakouts that you trade after consolidation, even those trades can fail. Anything can happen in the market. But your winning probability is higher on the side where you have taken a breakout trade after a consolidation has occurred. Let's go to the charts now. I'll explain everything to you on the charts. I'll show you where to take entries and how to take entries on breakouts. There is a second thing also that I want to show you in this video. I will show you what happens when there is a big candle that breaks out and then you are left with a huge stop loss. So a lot of people have asked me about this as to how to trade these breakouts when breakout candles become very big. So sometimes it can happen, that the breakout candles become so big after the breakout because of sudden buying or sudden selling that there is no opportunity to enter. So instead of running behind such breakout candles, stay there, be patient and enter at a point which I will tell you in this video going forward. I will show you on the charts and then you will understand where to enter. Till then, sit on the sidelines, be comfortable, don't have the fear of missing out, don't suffer from FOMO, and definitely if the market comes to that specific level, you will be able to take the trade. We will see long and we will see short trades and we will go ahead accordingly. So let's jump into the charts now. But before we do jump into the charts, if you have not subscribed to the channel yet, please subscribe to it. Also like and also hit the bell icon so that you will be notified whenever I post a new video. How to avoid false breakouts. Now let's just first see this screen. Now the first condition here is to avoid breakout trades after back-to-back candles. So don't chase price. Okay, if you see back-to-back candles, you should not chase price. So what does this mean? Let's say we have a resistance like this and we have candles coming from the bottom like this, and here there is another candle and you see that a candle breaks out of the resistance. Okay, so these are called back-to-back candles. So if these are green candles, they are back-to-back candles. So you are not to take a long entry here. Okay, so you should not chase price, you should not run behind price, because it is a very high probability that here price will take some resistance and it will reverse. So whenever you see such candles one behind the other, you should not take a trade. Most often this candle here or this candle right here is a trap candle. That is one important situation in which you should not take a breakout trade. So avoid trading on back-to-back candles. Wherever you see there is a breakout, and there you should avoid entering the trade altogether. That is the first condition. What is the second condition? Take breakout trades only after a consolidation. Now let's take the same example here. I'll just draw a line here. Now let's say that we want to take a short trade and we want to see that if price gives us a breakout. Okay, so if candles are like this and you see that there are some small candles here and then price starts to consolidate here. Okay, it just keeps taking support and candles are formed like this and they consolidate here, and finally there is a candle that breaks out. Now this is the correct scenario to take a breakout trade. This is the scenario in which you should take a breakout trade. Okay, do not miss this. This is a check mark for the correct breakout trade. Now the breakout trade here has a higher probability of success. So what can you do here? You can place an SL on the top of this candle, and this is the breakout line, and then you can go short here at the low of this candle, and then you can take your profit accordingly according to your risk reward. So the second condition is that you must always look for consolidation before a breakout. Why? Because you see that this entire zone is a battle between buyers and sellers, and now in this case sellers have won the battle. So that is the second condition. And what is the third condition? It is very important to be patient in the market. You should wait for a candle close. You should not trade on wicks of candles. So let's go back to that same example. Let's say now we are looking for a long trade, okay, and here we have a candle like this, which is a red or a green candle, it doesn't matter, and then price starts to fall like this here. Okay, it could be a red or a green candle, it does not matter what the candle color is, and then price reverses and goes back to the high of that candle, and here it goes here and it kind of makes a wick out of here. So this is not a breakout here. Okay, there might be a wick like this on the bottom, it doesn't matter, but this is not a breakout. Now from here price starts to reverse again. It reverses, consolidates for a while here. Now at this point, let me just extend this line forward a bit. Okay, at this point, if there is a candle that comes and breaks out of this, now you can see that the high of the previous swing is here. So you will not consider this candle as a breakout candle, because this here, that is no more the high. The correct high is here. So a candle where it closes with a wick on top is not an entry candle. So you cannot say that this is an entry candle. Neither is this one here an entry candle. This is also not an entry candle. It needs a candle close above this particular level to ensure that you should go long. It does not matter whether there is a consolidation prior to that. This example itself is a strict no-no to any sort of breakout trade. This is not a breakout formula. This is not the price action for an accurate breakout. Okay, so these are the three conditions you should religiously follow if you are a breakout trader. And now we will start to go to the charts and we will see what sort of correct examples we have for breakouts. First, I will show you what sort of breakouts are incorrect. Okay, let's go to the 25th of February. You can see the date on the bottom. It is 25th of February. This is Nifty and 5-minute chart. Let's analyze the previous day first. What happened here? Price made a high here, and from this level price never came back to the high of the day. The price crashed on that day, but it never went to the high of the day. So now when you come back to the next trading session, you can see here that you've already marked the previous day high, which is this level here. Now when price goes up like this, it opens at this level here, then it makes a low here, and then you can see that the first candle is showing bullishness. Okay, this is a strong bullish sign. So now here you can see that price has rallied from here to here. Okay, and you can see that, let's just mark the day high from here again. Check these candles out. Back-to-back green candles. These are back-to-back green candles. So there is no consolidation. Do you see any prior consolidation here? There is absolutely no consolidation prior, and within this entire zone prior to the breakout, this is not called a consolidation. These are particularly higher highs, and you can see that there is an uptrend here, a clear uptrend, and then this candle breaks out of that resistance line of the supply zone. Now this is the supply zone, isn't it? Why? Because price fell from here to here the previous day, big fall. So the line, the black line, that is the PDH, becomes the supply zone, and so this particular candle does not become a breakout candle. And as you can see, the price has taken resistance here and it has given a false breakout and fallen again. So if you had gone long on this candle and you had kept your SL here, your SL was gone here. Now we are on the 31st of January. I have marked a blue line here. What does the blue line indicate? That it is a supply zone. Why? Because price has gone from the low here to the high here, then taken resistance and fallen. So this becomes the supply zone. Next day when you come, this is the PDH, the previous day high. So from here, when price reaches that level, you can see that price has given a breakout with this candle here. You can see the breakout candle here. Okay, but do you see any consolidation prior to it? Again, you can see that there is a trend here. There are higher lows here. So this is not a consolidation prior to the breakout. So again, you see that this candle gave the breakout, and if you had gone long here, your SL was somewhere below the candle. You took a long entry at this position here, and that long entry was triggered when the price or when the candle closed above the supply zone. You thought it is going to be a breakout, so you took a trade there, and then at this level your SL was gone after price took a resistance here and it fell again. So another trade gone. So that is why you should always look out for consolidation. You should not chase back-to-back green candles. Can you see these back-to-back green candles here? So these are higher lows. Price is making continuous higher lows here. So avoid such breakouts. Okay, now you can see that this is the 7th of February 2022. Now what do we see in this chart? See, let's analyze the previous day first. The previous day, price has been going in a particular range here. It took support here, it took support here, then it took a support here and fell. Then it came back here, it took a support again at around the same area, went up, again it took support, and from there it went up again. So price just kept doing that the entire day. The previous day low is a strong support because price has not been able to break it in spite of multiple tries. So price tried to break it here at this level with this strong first red candle. You can see that candle. Then it again tried to come down here and break it at this level but could not break it. Again at this level it tried to break it but could not break it. Again it tried to break it here but could not break that zone. So what do you do here? You know that that is a strong support. Okay, so what do you do the next day? You mark the PDL. Okay, this level is the previous day low, and you know that the PDL is a strong support. Now what happens later? When this candle opens, it opens at this level and then it makes a low here. Now this is the wick. Okay, the candle has not closed below the support level. So this is a wick. The low of the candle is here. Okay, so now support zone comes to this level. Okay, this becomes the support, the new support. And you can see that the third candle made a wick lower to that. You mark the low of that candle, and now when this candle here, this red candle, which is a strong Marubozu candle, that candle closes below that support, now you have an authentic breakout. Now this is a real breakout, this is not a false breakout. This particular red candle that you see could not close below this wick, so this is not a breakout candle. Even this candle here is not a breakout candle, because even though it looks like a strong red candle, this low has not been taken out by this particular candle. So this red candle also does not become a breakout candle. The only candle is this candle which has broken out of the new support. So you have to keep shifting the support below. When the day opened, this was the first support, then this was the second support right here, and then you shifted the support to level 3, and then this level was the one that indicated the breakout candle. Okay, and then from there you can see the kind of fall that price gave. So that is the way to identify correct breakouts and not run behind false breakouts. Now let's check out the 28th of February. Now I have already marked this resistance. Now what is this? This is a resistance coming from the previous session, the 25th. Price fell from here and then it never returned to that level. So we had already marked a level there. So you can mark a box around that zone. Now can you see here that price is again on the 28th, when it opened here, from here it fell, and then from here it went up and it rallied to exactly the same supply zone that we had marked, or the resistance that we had marked. So it took resistance here again, it took resistance here, it took resistance here, and then within this entire zone it kept taking resistance, and only after that this candle broke out. Now it's a different story that the candle happened very late, so there was not much time for price to move out from there, from that zone. So I wanted to show you what an authentic breakout looks like. When you see that price has taken resistance multiple times from that level and it is trying to break that level continuously, you can see that when a breakout happens after some consolidation here, that is a good breakout pattern to take a trade on. Not that this was the breakout candle that you should have traded on, but I'm just trying to show you where and how breakout candles can happen and why that particular location is important and why the price action is important. Now it is obvious that after a rally from here to here, there is no point taking a breakout trade here because it is already almost at the day end, and even so, even after price has rallied so much of the trend is already over. So the bulls are already exhausted. So obviously that is not the correct place to take a breakout trade, but I'm just trying to show you how levels are respected and how after multiple retries a level can be broken. Now this is the 21st of February 2022. Now here you can see the sort of price action that the previous day had shown. You can see the first candle of the day here. This is the green candle, and this green candle showed strong bullishness because from there the price bounced so much. So that is a strong demand zone. Now going into the next day, even before the day opens, you know that the PDL is a strong demand zone. But what happened here on this day? On the 21st of February 2022, the price opened with a strong red candle and price took a major fall from there. And now here you know that the demand zone here is acting as a strong resistance. So now whenever price comes back to the same level here, it is going to take resistance. So now if you are a supply demand trader, then you know that demand zone, let's call it DZ, converts into a resistance if price comes from the bottom. Similarly, a supply zone, let's say it is SZ, becomes a support whenever price comes from the top. So this is exactly what happened here. You can see that price opened right inside that demand zone, which now becomes resistance, and it took a major fall. Then after this swing, it went up. Okay, here it spent some time within this zone. You can see how much time it has spent. So let's see, this is 1, 2, 3, 4, 5, 6, 7, 8, and the 8th candle here broke out. And then you can see the kind of rally that it gave. So this is how you should identify the correct breakouts. Okay, from here to here you can see that price was taking resistance and finally it broke out with a strong green Marubozu candle. It is a very strong bodied candle with minimum or no wicks on the top and bottom. These are the breakout candles that you can trade on. Now this is the 28th of February. That is the previous trading session, the last trading session that we had on the last day of February. I've already made an EOD video on this, so you can go back and watch that video. You can see here that the day opened with a red candle here. The current day high is here. Okay, that day high was broken with this green candle. Now price has gone from here to here without any stop. There is no consolidation, there is no pullback, there is absolutely no retracement anywhere. So without any correction, it has kept going up. So this is not a correct place to enter into a trade. And you can see how price has kept on making lower highs here right up to here, and at this point this is the CPR. So you know that CPR acts as a very strong resistance when price comes from the bottom. So you can see the resistance here that CPR has given and the consolidation within the CPR. So let's calculate this. This was the first candle. So 1, 2, 3, 4, 5, 6. So that is 30 minutes worth of consolidation within the CPR, after which this candle is formed. So if you are a breakout trader who trades on breakouts based on supply demand zones and important resistances and supports like the CPR, then this is your bread and butter. So you can depend on the breakout candles like these to take good quality trades, and then here you can take your profit back at the previous day high, which is another important resistance. So you should not keep your trade open after the previous day high. This is where consolidation is important. You know that there has been a fight between buyers and sellers at this level, and then when such a candle is formed, you know that the buyers have come out triumphant and they have won that battle, and now you can side by the buyers and then you can confidently take that trade. I do not mean to say here that price will keep going up like this from here to here. There is every probability that the price from here might take resistance somewhere and give a fall again, and it might take your SL if your SL is here or here somewhere. But you're always mitigating your risk, so you're controlling your risk with your stop loss. So you should always know that you must go in with a stop loss, because you should keep a probability mindset. You can never be sure that any trade will work in your favor. Having said that, you should always take high probability trades. There's a 50% chance of you winning that trade. But if you're picking out low probability trades, then obviously the probability of winning has come down even before you have taken that trade. Now let's study this. This is the 5th of January 2022. And what happened here? Price opened with this bullish kind of a candle. It is a green candle with a long wick on the bottom, but not a very strong body. So here this was complete volatility. Price went here, it took resistance, it fell here, it took support here with a strong green candle, it shot up here, and from here it fell again. So what does it mean? That in spite of such strong green candles, it cannot break this particular blue line here. So what does it make it? This makes that line a strong resistance. So you should mark that level out as a resistance, and from that place, when price approached that level again, you can see the kind of consolidation that price gave, and such a long consolidation before this breakout candle is formed. So how many candles are these? 1, 2, 3, 4, 5, 6, 7, 8, 9. So this being a 5-minute candlestick time frame, price consolidated for nearly 45 minutes before that level was broken. And then after that breakout, you can see how price gave a nice rally, and you could have easily taken a trade on the high of this candle and kept your SL below and taken good profits in this trade. So that is how you should read authentic breakouts. So there you have it, guys. That was what I wanted to share with you today. It's a very simple concept. Just don't run behind breakouts just because they are breaking a level. Think logically. Think if one side has emerged as a winner and only then enter. Your winning probability will increase a lot if you follow this one strategy. This is the one strategy that I have started following since years now. So I'm sharing this experience with you today. Always ensure that you watch price action. Learn how to mark support and resistance on the charts. Learn how to mark important levels. I have a lot of videos I have posted on EOD analysis. You can go back and check those videos also. You can also go back and check the strategies that I have made inside the strategies section. So you will be able to know how to trade breakouts and how to trade reversals. I think that's it for this video. If you liked it, please hit the like button. Also subscribe to the channel and hit the bell icon so that you will be notified whenever I post a new video. Thank you for watching, and I will see you in the next one.